Listen carefully. If you own silver, what I'm about to discuss is not a prediction built on hope, and it is not another argument about short-term price action. I am talking about a structural shift that could reshape how wealth is preserved, measured, and transferred as we move through 2026. Most people are still looking at silver through the lens of the last cycle. That is precisely why they are vulnerable. The majority of investors continue to evaluate markets using assumptions that were built during an era of expanding confidence. They assume debt can continue growing indefinitely. They assume policymakers will always find a solution. They assume liquidity can always be created without consequences. Most importantly, they assume the system itself remains fundamentally stable. You need to understand something. Systems do not fail when everyone expects them to fail. They fail when confidence remains high, even as the underlying foundation weakens. That is what makes major transitions so dangerous. They develop quietly beneath the surface while headlines focus attention elsewhere. I am not talking about a minor correction. I am not talking about a temporary slowdown. I am talking about pressures that have been building for decades. The global economy has become increasingly dependent on debt expansion. Every cycle has required more intervention than the cycle before it. Every crisis has demanded larger liquidity injections. Every slowdown has been met with increasingly aggressive policy responses. The pattern is clear. The amount of support required to maintain stability keeps growing. History has proven this again and again. When a system requires constantly increasing intervention simply to maintain normal conditions, that system is no longer healthy. It has become dependent, and dependency eventually creates fragility. This is where most investors make a critical mistake. They focus on market performance while ignoring monetary structure. They watch stocks rise and assume the system is strong. They watch economic reports and assume stability remains intact. But the real question is not whether assets are rising. The real question is why they need so much support to continue rising. That distinction matters, because once you begin examining the foundations instead of the surface, a very different picture emerges. Debt burdens continue expanding. Fiscal deficits remain elevated. Interest expenses consume a growing share of government resources. Central banks face increasingly difficult choices. If they maintain restrictive conditions for too long, financial stress increases. If they ease aggressively, currency purchasing power suffers. Neither path is comfortable, neither path is easy, and neither path resembles the environment most investors became accustomed to during previous decades. This is why Ray Dalio's broader warnings deserve attention. The issue is not a single asset. The issue is the architecture surrounding that asset. Silver holders often spend too much time asking whether silver can reach a specific number. In my view, that is the wrong question. The more important question is whether the monetary framework measuring silver can maintain its credibility under growing pressure. Because if confidence in that framework weakens, asset pricing changes rapidly. Most people assume they will recognize the shift when it arrives. They won't. Structural transitions rarely announce themselves. They appear fragmented. They appear temporary, they appear manageable, then suddenly they become obvious. By the time consensus forms, the largest opportunities have already begun moving. This is not speculation, this is the recurring pattern of financial history. Major changes start with a small group recognizing structural realities before the broader public acknowledges them. Eventually, perception changes, then behavior changes. Then capital moves, and capital movement is what drives repricing. You need to understand the unique position silver occupies within this environment. For years, silver has been viewed primarily through the lens of volatility. Investors remember frustrating periods of sideways movement. They remember false starts. They remember corrections that damaged confidence. That history has created skepticism. Ironically, skepticism is often present before major transitions. When everybody already believes in an asset, expectations become difficult to exceed. When disbelief dominates, the situation becomes very different. The real opportunity often emerges before public perception catches up with changing realities. This is especially important because silver exists at the intersection of two powerful forces. It has industrial relevance. It also carries monetary significance. During periods of stability, investors tend to focus on the industrial side. During periods of monetary uncertainty, attention shifts toward its role as a store of value. That shift in perception can be extremely powerful, not because silver itself changes, but because investors change how they view it. And perception drives allocation, allocation drives demand, demand drives repricing. Most people underestimate how quickly that sequence can unfold. They assume there will be ample warning. They assume there will be time to react. They assume confirmation arrives before major moves begin. Financial history suggests otherwise. The largest transitions often feel uncomfortable in their earliest stages because certainty has not yet arrived. The crowd waits for reassurance. Institutions wait for validation. Analysts wait for consensus, but consensus is usually the final stage of recognition, not the first. That is why 2026 matters, not because a specific date guarantees a specific outcome, but because the structural pressures that have been building for years are becoming increasingly difficult to ignore. The debt cycle is advancing, monetary credibility is being tested, policy flexibility is narrowing, and the gap between financial reality and public perception remains unusually wide. That gap never stays open forever. Eventually it closes. The only question is how quickly. And in the next part, I want to go deeper into the mechanism that could force capital out of traditional financial assets and into monetary alternatives like silver faster than most investors currently believe possible. Now I want you to focus on the mechanism itself, because this is where most investors lose sight of what truly matters. Markets are not driven solely by numbers. They are driven by confidence in those numbers. That distinction is critical. A debt-based monetary system can function for a very long time as long as participants maintain confidence that future obligations can be honored and future growth can support present promises. The moment that confidence begins to weaken, however, the entire structure becomes more sensitive to stress. This is not because the system suddenly changes overnight. It is because perception changes, and perception is often the most powerful force in finance. Most people assume that debt becomes dangerous only when it reaches an extreme level. In reality, debt becomes dangerous when markets begin questioning whether that debt can continue expanding without consequences. That is the threshold investors should be watching. Not headlines, not daily volatility, not political narratives. The threshold of confidence. Right now, governments around the world face a difficult reality. Borrowing requirements remain enormous. Existing obligations continue growing. Refinancing needs are increasing. Interest expenses consume larger portions of budgets. These are not temporary issues. They are structural conditions. For years, low interest rates helped conceal the scale of the problem. Cheap borrowing reduced pressure. It allowed governments, corporations, and consumers to extend obligations further into the future. But every cycle changes, and when the cost of money rises, even modestly, vulnerabilities become more visible. You need to understand what happens when financial systems become trapped between inflation and debt. If policymakers fight inflation aggressively, they increase pressure on highly leveraged sectors. If they support growth aggressively, they risk weakening purchasing power. Both paths involve costs. This is why I keep emphasizing that the real issue is not a single policy decision. The issue is the narrowing range of acceptable choices. Healthy systems possess flexibility. Fragile systems do not. The more constrained policymakers become, the more investors begin searching for alternatives outside the traditional framework. That search is what matters. Because once capital starts looking for protection rather than performance, asset preferences change. The priorities change, the psychology changes, and eventually the pricing changes. History has proven this repeatedly. During periods when monetary confidence weakens, investors gradually move away from assets that depend heavily on trust and toward assets that possess intrinsic scarcity. This process does not begin dramatically, it begins quietly. A small allocation adjustment here, a defensive position there, an institutional hedge, a portfolio rebalance. At first, few people notice, then momentum begins building. What makes silver particularly important in this discussion is the size of its market relative to global capital pools. Most investors do not appreciate how small the available investment silver market actually is when compared with pension funds, sovereign wealth funds, institutional portfolios, and global private wealth. The imbalance is enormous, and small markets respond differently than large markets. Large markets can absorb significant flows without dramatic changes. Small markets cannot. When demand enters a constrained market, prices adjust faster because supply cannot instantly expand to accommodate new interest. This is simple market structure. Yet most people ignore it because they assume future demand will resemble past demand. That assumption may prove dangerous. Remember, silver is not dependent on a single source of demand. Industrial consumption remains important. Technological applications remain important. Energy transition trends remain important. But during periods of monetary uncertainty, another force enters the equation: monetary demand. That is when silver stops being viewed primarily as a commodity and starts being viewed as protection. That reclassification changes everything because monetary demand behaves differently than industrial demand. Industrial buyers focus on operational needs. Monetary buyers focus on preserving purchasing power. One is driven by production. The other is driven by confidence. And confidence can change rapidly. This is the part most investors underestimate. They imagine future adjustments occurring gradually over many years, but financial history repeatedly demonstrates that confidence-driven shifts compress time. Movements that appear impossible under normal conditions become entirely possible during periods of revaluation. The real question is not whether silver can attract capital. The real question is, what happens if confidence in traditional stores of value begins deteriorating while capital simultaneously searches for alternatives? That combination creates powerful feedback loops. Rising prices attract attention. Attention attracts additional capital. Additional capital attracts more attention. The process becomes self-reinforcing. And because silver operates within a relatively constrained market structure, the impact can be amplified. This is why waiting for certainty often becomes expensive. Most investors believe they will recognize the opportunity after confirmation appears, but confirmation usually arrives after repricing has already begun. The crowd feels comfortable entering once the narrative becomes widely accepted. By then, however, risk-reward dynamics have changed. The asymmetry has diminished. The advantage has narrowed. The early phase is gone. Listen carefully. I am not saying every day will be positive. I am not saying volatility disappears. I am not saying timing becomes irrelevant. What I am saying is that structural forces matter more than daily fluctuations. And structural forces are moving in a direction that deserves serious attention. Debt continues expanding. Currents of purchasing power faces pressure. Policy continue increasing. Confidence remains heavily dependent on intervention. Those realities cannot be ignored indefinitely. At some point, markets begin repricing risk. At some point, investors begin questioning assumptions. At some point, capital begins repositioning. That is when transitions accelerate. Most people think wealth is lost during crashes. Often, wealth is lost much earlier. It is lost when individuals fail to recognize structural change while it is still developing. By the time the consequences become obvious, opportunities have already shifted. That is why understanding the process matters more than predicting a date. The exact trigger remains unknown. The underlying structure does not. And in the next part, I want to examine why regime changes historically create some of the largest wealth transfers in financial history, and why silver could become one of the most closely watched assets if that transition begins accelerating in 2026. Now, we need to go one level deeper because this is where the conversation stops being about silver alone and becomes a discussion about wealth itself. Most people think wealth is money. It is not. Money is simply the tool used to measure wealth. Real wealth consists of productive assets, resources, ownership, purchasing power, and the ability to preserve value across time. That distinction becomes critically important during periods of monetary transition. Why? Because when the measuring unit becomes unstable, people often confuse rising nominal values with increasing wealth. They are not always the same thing. History has shown repeatedly that major debt cycles eventually force adjustments. Sometimes those adjustments occur through restructuring, sometimes through financial repression, sometimes through inflationary policies that gradually reduce the real burden of obligations. The method changes, the outcome is often similar. The purchasing power of the currency absorbs part of the adjustment. This is why investors who focus only on nominal numbers frequently misunderstand what is happening around them. A portfolio may appear larger, account balances may rise, asset prices may increase, yet purchasing power may not improve at the same pace. That is the hidden danger, and it is one of the reasons hard assets repeatedly attract attention during periods of monetary uncertainty. You need to understand that regime changes are not normal market events. They are periods when long-standing assumptions stop working, correlations change, valuation models change, investor behavior changes. What worked for years may suddenly stop working. What was ignored may suddenly become important. What seemed unnecessary may suddenly become essential. This is why I believe so many investors are underestimating the significance of the environment developing ahead. They are anchored to the past. They assume the next decade will resemble the previous decade. They assume the same strategies will produce the same outcomes. But major debt cycles rarely conclude by preserving the status quo. They conclude by changing it. That is the point many people miss. The real question is not whether the system survives. The real question is what form the system takes after adjustment occurs, because adjustment is unavoidable. You cannot expand obligations forever without consequences. You cannot increase debt faster than productive growth indefinitely. You cannot continuously rely on intervention without eventually reducing its effectiveness. This is not ideology, it is arithmetic. And arithmetic eventually imposes limits. Most investors are completely blind to what is forming because they continue evaluating conditions through a framework that assumes stability remains permanent. Stability is never permanent. Every financial era eventually reaches a transition point. Every monetary arrangement eventually faces pressure. Every debt cycle eventually encounters constraints. The only uncertainty is timing. The direction is often much clearer than people realize. This is where silver becomes increasingly important, not because it is magical, not because it is guaranteed, not because every forecast will prove accurate, but because silver occupies a position that becomes more relevant when confidence in traditional monetary structures begins weakening. It exists outside direct policy creation. It cannot be printed into existence through a vote. It cannot be expanded at will to solve budget problems. Its supply requires effort, capital, and time. Scarcity matters. Especially when trust becomes questioned. Think about what happens when investors begin recognizing that preserving purchasing power may become more important than maximizing short-term returns. Portfolio priorities change, risk definitions change, capital flows change, and when capital flows change, markets reprice. The crowd often assumes wealth transfers occur because a few investors become lucky. That is rarely the real explanation. Large wealth transfers usually occur because some participants recognize structural changes before the majority does. They position accordingly, then they wait. The majority waits for certainty, the minority focuses on structure. That difference often determines outcomes. I want you to think carefully about where we are today. Debt remains elevated. Deficits remain persistent. Monetary flexibility continues narrowing. Confidence remains dependent on policy credibility. These are not isolated facts. They are interconnected signals that suggest the system is under increasing strain. Strain accumulates. It does not disappear. It builds beneath the surface. Then eventually it becomes visible. When that visibility arrives, market behavior changes rapidly. This never ends quietly. The transition from confidence to concern is rarely smooth. The transition from concern to action is often even faster. And once action begins, capital does not move evenly. It searches aggressively for protection. It searches aggressively for scarcity. It searches aggressively for assets capable of maintaining value when confidence weakens elsewhere. That environment can create powerful repricing events, not because fundamentals suddenly appear, but because perceptions suddenly change. Perception drives allocation, allocation drives demand, demand drives valuation. The sequence repeats throughout financial history. What makes the current environment particularly important is that multiple pressures are developing simultaneously: debt pressure, currency pressure, fiscal pressure, geopolitical pressure, confidence pressure. Individually, each challenge might be manageable. Together, they create a far more complex picture, and complexity often produces unintended consequences. The market does not need every problem to arrive at once. It only needs enough participants to believe future stability is becoming less certain. That shift in belief changes behavior. Behavior changes allocation. Allocation changes prices. That is the mechanism. That is the process. And that is why I believe silver holders should pay attention to the structural forces developing beneath the headlines. This is not about chasing excitement. It is not about predicting a precise number. It is not about guaranteeing a specific outcome. It is about Recognize that wealth preservation becomes increasingly important when systems enter periods of adjustment. Ray Dalio's broader message has never been about fear. It has been about understanding cycles, understanding incentives, understanding debt, understanding monetary history, and understanding that major transitions often appear impossible until they become obvious. The real question facing investors today is not whether change is coming. Change is always coming. The real question is whether you recognize it early enough to position accordingly, because once the crowd fully understands what is happening, the opportunity is different, the pricing is different, the risk is different, and the advantages available during the early phase have largely disappeared. You can dismiss these structural pressures. You can ignore them. You can assume the next decade will look exactly like the last, but history suggests otherwise. History suggests that periods of excess eventually force adjustment. History suggests that confidence eventually encounters limits. History suggests that debt cycles eventually reach turning points, and when those turning points arrive, markets reprice according to reality rather than assumption. That is the shift you should be watching. That is the shift that could reshape wealth preservation in 2026. And that is the shift most investors still fail to see clearly.